Hello and welcome to the next of our full course lectures. This is a continuation of our corporate governance. We're looking now in particular at shareholder relations. So one of the key aspects of good corporate governance is the relationship that the company has with its shareholders. It should maintain that relationship and ensure that they communicate with those shareholders. So what exactly should they do? Well, as I've said, what they should do is first of all, inform and interact with its shareholders. And we'll see later on in this lecture that institutional shareholders will be one of the main aspects that they'll need to deal with. Institutional shareholders, remember, are those large companies that hold big bulk amounts of our shares. So we need to inform them and we need to interact them. So that's two different aspects. So we need to provide them with information. That will be the inform aspect. And we need to interact with them, i.e. we need to communicate if they ask us questions. So one of the key aspects here is that communication. So we must inform them, we must communicate with them. So as I've said, who is it that we're talking about here? Well, the first one is those institutional shareholders. Those are the pension funds, the insurance companies who hold large bulks of shares in our company. So they may hold maybe 10% of the shares. That's a big shareholding. They will have a lot of sway when it comes to voting rights on AGMs, etc. So institutional shareholders, we must inform them, we must communicate with them, we must interact with them. But don't forget that there are the individual shareholders. Now they will wield much less power because there's not really much they can do. Yes, they have a vote at the AGM, but one vote isn't going to change much. So they need to be thought about, but they won't have the power of the institutional shareholders. So let's look in a little bit more detail at these institutional shareholders. Remember, these are often the dominant shareholders in the organisation. They may well own more shares than anyone else in the business. So there are some problems that we have with these institutional investors. The first problem that we may well have with our institutional investors is that they often focus on the short term. Remember who these institutional investors are. They're pension funds, they're insurance companies. They, although pensions are long-term investments, will often be judged on the short-term performance of their fund. So that means that they're often interested in short-term results. They're not so interested in the long term. They may well also have a lack of understanding. So although the people who run those companies, those pension funds and insurance companies may well know how to do that, they may well not have an understanding of exactly what your business does. So that means that they may be demanding things that simply aren't possible. So they may well have that lack of understanding of the business. Of course, then we also have the agency problem. The management are acting on behalf of the agents who are the shareholders, and that raises all of the different problems we've looked at when it comes to that agency problem. So there are some things that shareholders can do. This is called shareholder activism. They can get active and do things to try and change the way a business is being run. So what could they do? Well, the first thing they could do is use their rights positively. They'll have different rights, for example, voting in the AGM, voting at the EGM, using those rights to actually vote out things that they don't want, or indeed to issue a protest vote to ensure that management understand what the problems are as they see them. They can use that then to engage with the directors, or they can even communicate with the directors directly and explain to those directors exactly what they think the problems within the business are, and often institutional investors will do this. They could also present resolutions at the AGM or the EGM to try and challenge the board, to try and change the strategic direction of the business, or indeed just to voice their disagreement with a certain policy. So there are various different things that shareholders can do, particularly these institutional shareholders that will own big blocks of shares and therefore have voting rights that can influence what actually happens. So how can institutional shareholders actually intervene? So when it gets down to the actual details, some of the things that the institutional shareholders can deal with are: number one, they can challenge the strategy of the business. So we've already said that they can present resolutions and engage with the directors. Well, they can do that to challenge the strategic direction of the business at this current time. And this happens quite regularly with institutional investors. They don't like the way the business is being run. They don't like where it's achieving that competitive advantage, or indeed not achieving it. And they challenge the strategy that the directors currently have in place. They can also question the performance of the business. So if they're not pleased with the return that's being generated, they can question why that's the case, look at the key performance indicators that the business uses, and perhaps put pressure on management to change those. One of the key things that they'll often do is block acquisitions. Acquisitions are often fraught with danger. Oftentimes, businesses that acquire other businesses actually don't do very well in doing it. So institutional shareholders recognize that and often will block acquisitions, will vote against acquisitions of other firms for the fear that those acquisitions may well damage the firm rather than maybe given the synergies that they expected. One very topical issue is that they could question the remuneration of the directors. So this has come up recently with various different cases where directors have been poorly performing and yet have been paid astronomical sums. Well, it's now becoming that the institutional investors will start to question this remuneration. So that needs to be done. They need to be able to use their votes to actually vote against remuneration and question why directors are actually achieving it. They can also review internal controls. So remember, directors will be responsible for those internal controls to prevent fraud and error, and we'll be looking in detail at internal controls later on in the course. They can review those and make sure that they're actually sufficient for what the business requires. Lastly, institutional investors can ensure compliance. They can make sure that the business is complying with all its legal requirements, complying with all its statutory requirements, and ensuring that the business is run in the correct way. So let's look at this in a little bit more detail in illustration 1. Now, this is an introduction to a longer scenario. So although the requirement is quite short, the scenario is quite long, but I want to get you used to reading this length of a scenario and being able to pick the information out of it. So do that first, read the scenario right the way through, then look at the requirement, perhaps have a go at the requirement, and then work through the answer with me to learn from it. The requirement for illustration 1 here is that we have to explain the factors that might lead institutional investors to attempt to intervene directly in the management of a company. So we're not really making this too relevant to the scenario. This is just learning. It's thinking about those factors that we've just discussed in the lecture. Now, do make sure, not so much for this section, but make sure you read through the scenario here because it's a really interesting scenario to read. It's clearly based on the Enron scandal. So it gives you an idea not just of the scenario for the question, but also gives you an idea of what was happening in that scandal. So we'll need the scenario for the next part of the question, not so much for this part. We're just looking at those factors that might lead institutional investors to intervene. So let's get an idea of what those are. So institutional investors' intervention surrounds several main areas. Now, you could discuss them in any shape or form, but let's look at them now. So there may be concerns about strategy. Remember, we said that the directors will set the strategy for the business and the institutional investors may well be concerned with that strategy, especially when in terms of long-term investor value, the strategy is likely to be excessively risky or, on the other side, unambitious in terms of return on investment. So they need to find that balance between risk and reward. So if they're concerned about the strategy, the institutional investors may well intervene. Poor or deteriorating performance, usually over a period of time, although a severe deterioration over a shorter period might also trigger intervention. So any type of poor performance really is going to get institutional investors worried. So that will be especially so if the reasons for the poor performance have not been adequately explained in the company's reporting, or if it's suspected that the reasons for the poor performance is poor corporate governance. That will be a big problem for institutional investors. Also, we have poor non-executive performance. Remember, the non-executives are in there to give that balance, and it's particularly concerning when non-executive do not, for whatever reason, balance the executive board and provide that input necessary to reassure the markets. Their contributions should always be seen to be effective. So if they're not seen to be effective, well then that's going to worry the institutional investors. They need someone in there who's actually going to balance that board and provide an investor point of view. Major internal control failures. This is a really big one. There are clear signs sometimes within a business that there's a loss of control by senior management, particularly over the operations within that business. So those might refer, for example, to health and safety, quality, budgetary control, IT projects. In the scenario that we've just seen, there were clear issues over the control of the systems for internal controls, particularly in the financial reporting data. So that will be a big concern for institutional investors and could well get them interested in intervening in the business. Also, poor corporate social responsibility or ethical performance, lack of social responsibility, all of that will mean that the business may well not be putting out the correct image, and that may well instruct institutional investors and encourage institutional investors to intervene. Couple of last ones. Compliance failures. Remember, we said that if you're not complying with statutory regulations, for example, or indeed corporate governance codes, that may well encourage the institutional investors to get involved. Legal non-compliance is always going to be a serious matter, and the comply or explain for corporate governance codes must always be explained if they don't comply. So such explanations may or may not be acceptable to shareholders, but the explanation must be given so that they can make that decision. Lastly, excessive directors' remuneration, which indeed we see in the scenario, or defective remuneration policy, which is often an indicator of executive greed, or indeed excessive board salaries, which are likely to be an indicator of an ineffective remuneration committee. So that's usually a non-executive issue which will need to be dealt with, and if it's not dealt with, then perhaps the institutional investors will choose to intervene. Looking at the second part of illustration 1, the requirement here is to construct the case for institutional investors attempting to intervene in ZPT after the first results restatement was announced. So here we have the illustration where we have a scenario in which it's very similar to what happened at Enron. We have initially very good results, very good increases in share price, excessive rewards on the back of that, but justified on the basis of those results, and then restatements leading ultimately to bankruptcy. So could the institutional investors, after the first results restatement was announced, have got involved to maybe try and stop whatever was happening there? Well, the case for intervention surrounds these areas. Well, after the first restatement, there were at least 3 reasons for intervention. Thinking about those reasons that institutional investors may well intervene that we talked about in the first part of the scenario. So that means there was a good case for a meeting with institutional investors at least, so that they could discuss the matter with the board. So some of those reasons were, first of all, the poor performance. The restated results were all significantly below market expectations. Whilst this need not in itself have triggered an institutional investor intervention, the fact that the real results were only made public after an initial results announcement is unfortunate. So they should have got together with the institutional investors to let them know what was happening. The results were only made public after those initial results, so that's going to be a problem for the institutional investors. The obvious question they would need to ask is why the initial results were misstated. Why they had to be corrected at this point points to a complete lack of controls within the business. So it seems here like there have been lack of controls, in fact maybe even more than that, and that has led to the results being completely misstated. A set of results well below market expectations always needs to be explained to the shareholders. We also have internal control and potential compliance failures, and again we talked about that in the last little bit of this scenario to say, well, those are two main reasons that institutional investors may well want to get involved. There's ample evidence to suggest that the internal controls were very deficient, especially those internal controls over external financial reporting, and as mentioned there, those are crucial. So those internal controls over financial reporting to the external shareholders were deficient. That is a big problem. The case also mentions no effective management oversight of the external reporting processes and the disregard of the relevant accounting standards. That is a damning indictment. So not to mention the potential fraud in all of this means that we've got some very serious allegations. Some allegations that definitely should have been discussed with the institutional investors to keep them informed of what was happening. Also, we have the excessive remuneration in the form of the 20 million bonus. It's likely that this bonus was excessive even if the initial results had been accurate. So we already had questions asked even when the initial results were thought to be true. But after the restatement, the scale of the bonus was evidently indefensible as it was based on false figures, and that was the justification given for it, that the figures had been so good that this bonus was justified. Well, the figures were wrong, therefore the bonus was not justified. So the fact that the chief executive is refusing to pay the bonus back implies a lack of integrity, adding weight to the belief that there may have been some underlying dishonesty. So that implies that perhaps he knew what was going on. Furthermore, although investors thought it excessive, the case describes this as within the terms of Mr. X's contract. So a closer scrutiny of the remunerations policy would be appropriate, because maybe the non-executive directors hadn't been effective in their role on that remunerations committee to try and restrict the executive pay that was being offered. So those are some of the main reasons that it would have been more than reasonable for the institutional investors to have intervened after the first restatement of the figures. Now that we understand the relationship that the institutional investors have with the firm, what actually happens in the conducting of this relationship that the business should have with shareholders? Well, remember, the main thing that they'll have is the meetings with the shareholders. Those could be the AGM, the annual general meeting. That annual general meeting is for all shareholders. It happens once per year. So all of the shareholders will meet or have the right to go to that meeting. What they can do at that meeting is that they can vote on the actions of the business. So this is an opportunity for shareholders to vote on various things that come up during the year. It's also a chance for them to communicate with the board. The board will be at this meeting, they'll chair the meeting, they'll be there to actually answer any questions that the shareholders have, and there'll be a question and answer session for the shareholders to pose those questions. So it's not just a chance for the board to communicate to them, for the board to tell them what's happening. It's a chance for the shareholders to speak out, to talk back to the board and actually question them on their current activities. So the AGM happens once a year, the votes take place then, there's communication between the board and the shareholders, and there's question and answer sessions for those shareholders to question the board and its procedures. There may also be what's called an EGM, which is an extraordinary general meeting. This would be called, for example, for specific events such as a takeover bid, or if they were going to acquire another firm, because they may well need to take a vote on that. So generally speaking, an EGM will be for shareholders to meet up with the board for urgent issues to be covered. And as I said, that may well be takeovers. It could even be the raising of finance through such things as a rights issue, things that will need the votes of the shareholders to be passed. So those are the main times where the shareholders will meet with the board. Do remember also that if the shareholders are not able to attend the meetings, they do have what's called proxy votes. So they're not able to attend, they have a proxy vote, which means that someone else can vote for them if they have their permission to do so. So the UK code says that there should be a proxy for each resolution. The proxy must be recorded, so every proxy that's voted upon must be recorded, and there must be a published breakdown of those votes so that there's transparency and a clear way to show how the vote actually transpired. So those are the meetings at which the shareholder relationships will be managed. What disclosures do the businesses have to undertake to actually make sure that they manage this relationship with shareholders correctly? Well, there are some legal requirements. The legal requirements are that there must be a published annual report and a set of financial statements. And those must be sent to all shareholders. So those are the legal requirements. If you were just going by the legal requirements and nothing else, you would just have the annual reports and accounts to shareholders. But there are also some voluntary disclosures that you can make. For example, most annual reports will include Chairman and Chief Executive Officer statements. So those are statements by those two that explain how they see the business going in the future, how they feel the business has performed in this year, and provides a bit of a communication between the Chairman and the CEO and the shareholders. There'll also be a business review often. Now that will detail exactly what has happened in the business. That's not just the financial statements. That's looking in more detail at the operating review, at how they see the business performing in the future, how they feel it's performed over the current year, and how that relates to previous performance. Of course, you'll have the financial statements. You can maybe make them more detailed than the legal requirements in order to give more information. When it comes to corporate governance, there'll be a corporate governance report, and that will outline all of the committees that we've talked about: the remuneration committee, the nomination committee, the audit committee. It'll detail the members, it'll detail the work undertaken by those committees. It will give the names and details of the directors involved in the business, and details of the AGM, when it happens, where it happens, and who's entitled to attend. So all of this will be disclosed in the annual report. So with the financial statements, there'll be an annual report that outlines all of these different issues. So why do we have these requirements, and why do we have some voluntary disclosures by businesses to the shareholders? Well, it's to try and increase accountability to shareholders. So this feeds into our agency problem that we know all about at the moment. We must have that accountability. Because the managers are managing the business on behalf of the shareholders, they must be accountable to the shareholders. And this is a method for them to provide the information to be accountable. That will help shareholders and prospective shareholders make investment decisions. So prospective shareholders may choose to buy on the basis of the information in the annual report, or indeed current shareholders may choose to sell on the basis of that information. They'll also need to do it to be in compliance with the codes. Remember, the UK Corporate Governance Codes outlines all of these disclosure requirements and says you must comply with them or explain why you haven't. So to do that, you need to disclose all of that information. What we're trying to do here is provide a complete view to stakeholders. We're trying to ensure that they understand the business. We're trying to ensure that we give them all of the information that they need in order to make decisions. The key word here to remember is transparency. We looked at that word in detail earlier on in the course. Remember, that is having a position of revealing information unless there's a very good reason why we shouldn't. So giving all that information to the shareholders in order to communicate with them and in order that they can make the correct decision. So that was our session on shareholder relations and the importance of informing and interacting with our shareholders.